Hi, folks. Sandberg here with the daily scan for Tuesday, April the 8th. It is Technical Tuesday. And I mentioned yesterday that I was running out of topics. And I had a number of people actually ask me to cover how to use technical analysis for long-term investing rather than for trading. So that's going to be the topic today once I talk about what happened with the market. So stay tuned for that. That should be an interesting one. Let's jump in real quick and take a look at what happened. If it wasn't for Technical Tuesday, I would probably have some graphic here that would look like a whipsaw, whatever that is. I don't know what that would look like, but that's pretty much what we have today. So here's the market bias chart. And by the way, for anyone that is a subscriber to the website, I am doing a Zoom call on Saturday the 12th at 1 p.m. Eastern Time. For anyone that's interested in joining, if you are a subscriber. And if you are not and are interested, down at the bottom of the homepage, the $0 just allows you to get notified when the free newsletter is available. Or you can sign up for a monthly, you get a 7-day free trial. Or the annual gives you everything that I show, everything that I use here for 1 year for $99. Pretty cheap, actually. All right. Let's jump into it. We'll look at the charts real quick. S&P. This should show you the whipsaw that I was talking about. Yeah, look at that. Big red one there. Looked like yesterday it all was over. We're coming back. And we look like it today, this morning as well. Had a really nice uptrend this morning, but gave it all back. Did not come back down to the open from yesterday, but gave most of it back. And actually we don't have today's volume bar on here yet, but that's what the S&P looks like. The NASDAQ 100, same thing. Big red bar today. It actually opened higher than 2 days ago, but gave it all back. So unfortunate, but that's the way it is. But interestingly, the ADX line is actually going down, even though we went down quite a bit today. So, and you can see the histogram up here is still not as low as it was for this low. So there's still an opportunity. There's still a chance that we could have a bullish divergence with the histogram up here. We shall see. Tomorrow's CPI, I talked about that yesterday. Could be positive for the market. We'll see. Russell 2000. Big, huge red bar today on the Russell. So everything gave pretty much everything back from yesterday. Bitcoin, look at that. Bitcoin today also selling off, starting to recover yesterday. You can see down here, this is MicroStrategy. MicroStrategy is ended at the low of the day. And they're actually, looks like they're accelerating to the downside faster even than Bitcoin is. So we'll keep an eye on that, see what happens. All right, let's go over to first, I'll do the market bias matrix. And yesterday I mentioned that the short term was only 4%. You can see, you can just barely see it right there. I'll try to make it a little bit bigger. So yesterday was 4%. It actually came up to 5% today. How about that? Because of this small cap growth actually got a bullish signal today. And the charts for all these are right over here on the left-hand side. So amazingly, even though we had this, it opened way up here, pulled all the way back, but because it was right on the verge of crossing over, it actually gave a short-term bullish signal today. That's the only reason that went from 4 to 5. Just that one right there. Come back a little bit more. So that's what that looks like. Let me show you something else that will really highlight how bearish this market really is. On the trend model for the Magnificent Seven, shows short-term, medium-term, and long-term. And it will show you the dates that those changed. And look at these are all the big cap tech stocks. So the first 10 up here are the top 10 stocks in QQQ in the NASDAQ 100. Costco, incidentally, is one of those top 10. So those are the top 10, and then there's a couple of other ones, Arista, Palantir, and Eli Lilly down here. But look at the short term and medium term. Every single one of them is red. All of them are red. And we just got today and yesterday, we just got long-term signals for Google, and yesterday for Apple also turned red. And Arista and Lilly were already long-term red. Lilly all the way back to December of 24 had a long-term bearish signal. So if nothing else, that shows you just how bearish the market is right now. You can see that as well on the charts page. Down near the bottom is the Magnificent Seven. And you can see right here, it's pretty much the same thing. Short-term, medium-term, and long-term. Everything short and medium are red right there. Just got a long-term red for Google today, and we got that yesterday for Apple. Already had it for Microsoft and NVIDIA, for Arista Networks and Lilly. So there's only 1, 2, 3, 4, 5, 6, 7 out of these 10 that don't have a long-term bearish signal. Everything else is red. If that is not a bearish market, I don't know what is. So while I'm over here, let's take a look at a couple of things that are interesting that I looked at earlier today. First, let's take a look at the risk on, risk off chart. So this shows you down here junk bonds versus 20-year treasury. So if Wall Street is risk on, then they're buying junk bonds. If they're risk off, they are selling junk bonds and buying 20-year treasuries. And that's what's happening right now. So if this trend is down, that means the second parameter is outperforming. The first parameter is underperforming. Junk bonds versus high yield corporates. Not only is it down, it's accelerating down. High yield corporate bonds versus 7 to 10-year treasuries. Same thing, accelerating down. Growth versus value, accelerating to the downside. Discretionary versus staples, accelerating to the downside. And look where all of this really started. Right back here, I'll show you. So here's where the whole market started to roll over. That's February 21st, February 20th, let's call it. And just follow that line down. You can see junk bonds versus 20-year were already heading lower. The purple one was already heading lower. The green one was slightly going lower. The growth versus value was definitely going lower. The discretionary versus staples really wasn't much, but you can see actually it was, because this vertical line is February 20th. So it was already going lower as well. So they were already giving warning signs that this was coming. And now it is accelerating to the downside. So something that we will keep an eye on and watch for a potential turnaround. Price to earnings ratio has come down as well. Although you'll see here, this dash line is PE of 30. That's where it was back here in middle of February. It's come all the way down to 24.88. It's come down below 25 now, right below this red line. So that red line is 25. That's the area where the market starts to worry that PE ratios are too high. Well, it may not have to worry that much anymore. Now we've got earnings coming up next week, so this might change things as well. Might actually accelerate this one to the downside. You can see how it's accelerated already since middle of February. And down here you have the CAPE ratio. That's the cyclically adjusted price to earnings, or inflation adjusted price to earnings ratio. So that's versus the regular PE, and down here is versus the 10-year treasury. What you'll notice on earnings, and earnings is just coming up next week, is just starting. Actually, this Friday it's just starting. Earnings has really been flat. It's leveled out. It's actually a little higher than it was back here in 22, the beginning of 22, but leveled out even as the PE ratios are coming down, which, you know, it makes sense because the prices are coming down. So the P part of PE is going lower, even though earnings have really not been reported yet. So if companies start missing earnings, then the PE ratio may drop even more. So this is something to keep an eye on as well. And then, of course, the bottom finder. This is pretty interesting. I showed this yesterday, and I showed it Friday because I said I wanted to do the scan for the stocks because it might not go much lower. Well, guess what? It went much lower. Today, number of stocks above their 20 is 0. There are no stocks above the 20-day moving average out of 100. Number above the 50-day is only 4 stocks above their 50-day moving average, and only 18 above their 200-day. And you can see down here the VIX actually accelerated. This is the high for the day, so it accelerated even more, up to 52 for the VIX. That is extremely accelerated. The put-call ratio right here, it doesn't show it as well on this longer-term chart, but there is a put-call ratio, 5-day moving average of the put-call ratio down here as well. Right here, which shows here that it did get above the 72 level 2 days ago, briefly. But look at that. Even as the market continues to sell off, people seem to be buying calls. So going back to that topic of yesterday, buy the dip or sell the rip. Wasn't much of a rip today. We basically had a 24-hour, not even 24 hours. We had probably a half a day of a rip, and then it just reversed and came all the way back down again. But there's people buying calls still. So people are trying to buy that dip. They could get burned by doing that. Now, and this is very volatile right now. So the market is whipsawing significantly, going up and down. Look at the VIX real quick. There's the VIX. Interestingly, even though it went up pretty high, last was 52 right here. Day before, the high was even more than that. Actually, it opened higher than that. So 52, it actually went to 57 today and 60 yesterday. So it didn't go quite as high as it did yesterday. So maybe one last gasp of selling. We'll see. Either that or we will just continue lower. Let's take a look at the market cycle chart. This is the long-term chart. You can see. So we did not go as low as we were yesterday on an intraday basis. So that's good. So we have a higher low from yesterday, just one day. So it doesn't tell you much, but we have a higher low so far. And a higher high if you just take yesterday's candle. But doesn't help much because it sold off quite a bit. So we'll see. But this is a real example right here of the whipsaw that I'm talking about. This is just whipsawing back and forth. We could get another big move up again tomorrow if we get a good CPI number. We shall see. All right. Finally, let's go take a look at the dashboard real quick. So here's equities. You can see big up move in the morning and then just sold off most of the day from about 10:30 on. Continue to sell off. NASDAQ 100, they all look the same. VIX went way up. Bonds, 20-year actually came down some. 10-year went up. US dollar came down. Commodities, gold, hung in there, kind of went sideways. Silver, though, is pulling back quite a bit. Oil, there's oil, again, going much lower. Crypto, Bitcoin pullback right there, 77. It was lower than that yesterday. So it was down here to 75 yesterday, so it didn't get that low. We'll see what happens tomorrow. So that's what those look like. Down here, you can see the advancers, decliners, all decliners, pretty much all. Everything's red. Financials, utilities, industrials are at the top for sectors. Utilities is the most defensive. We've got discretionary, technology, and communication services are kind of in the middle of the pack. So, but they're all giving back. They weren't as low as the open. So that's something that was interesting to me today, is just looking at the open from yesterday. Everything opened really, really low. And that looked like capitulation, but we might not have completed that whole cycle yet. So we'll have to hang in there and see what happens. For industry groups, coal, number one today. We've got energy, healthcare, industrials, financials, industrials, utilities, financials. The only two aggressive sectors are at the bottom. They're both discretionary. So not too impressive, frankly. All right, so that's pretty much what happened today. We'll see what happens with CPI tomorrow. I talked about it yesterday, gave my opinion. I think it's going to come in lower. The forecast is to come in 0.2 lower, from 2.8 to 2.6. I think that's probably going to be accurate. That seems like the right place for me for it to go. So let's take a look at how to use technical analysis for long-term investing. I've had a couple of people ask me to talk about this. So I'm going to start here, and this is something that I did when I was working, when I had a 401k. I would watch the long-term chart. So when you're doing long-term investing, you want to be looking at the weekly chart, maybe even the monthly, depending on how far out your time horizon is. It means you're going to get some pullbacks that you're going to have to live through, like one right here last year. But when you get a big pullback like we had in 22, that's the time when I would move my money from an equity position in my 401k over to either a money market, if the 401k offers that, or into a bond fund if the 401k offers that as well. So you have to check your own, whatever your 401k management company is, to see what they offer. There usually are not a lot of choices. So it's either into an index fund to be in the market, or into a bond, or perhaps a money market to be out of the market. But that's what I would do. So my account typically would go up when the market was going up, and when the market started rolling over, it might come down a little bit in the beginning. Usually it would, because you can never catch the top and you can never catch the bottom. However, once I identified that the trend had changed, then I would move it into a cash account, quote unquote cash account, and it would go sideways. So my equity curve was up, sideways, up, sideways, up. So that was my goal. Now, since I am not working now at a full-time job anyway, I have moved all of my 401k into an IRA, and now I trade with my IRA. So it's tax deferred at this point. And, some people might think that's very aggressive, but because of my risk management that I always pay attention to, for me, it's actually not that aggressive. It's not that dangerous, basically, because I'll move to cash just like I did here. I'll move to cash when I see the market starting to go down. So how do you do that? So this is a weekly chart. First thing you'll notice, the way I have this set up is a 21-day. This is what I use on all of my charts. 21 days, the green line right here, and the red line is a 50. So you can see over here, 21 right here. I'll make this a little bit bigger. So 21, and that's an exponential moving average. And then the 50 is a simple moving average. And then down below is the 200 week. Remember when I talked about that yesterday, saying that was the signal of when the secular bull market is over, is the 200 week. So that you can see that right on the weekly chart. So this we're looking at the total stock market index right now. And this is getting dangerously close. But as I said, this is a weekly. So I actually want to look at it on the monthly. If it goes below it and then comes back up before the end of the month, that's okay. But we don't want it to stay down there. Go below it and stay there, because that will end the secular bull market. That will actually start the new secular bear market. So this is just a suggestion. This is just what I use. You can pick your own kind of charts, whatever moving averages you like. But I found this is a pretty good way to do it. Just watch where they cross. The reason I did some color coding in here, you can see I have the way I identify this is down here. You can see I have area. This is on stock charts. You make these areas. So I have lime down here for the 21 and red for the 50. And that shows me when I have a primary trend change. So when it changes from green to red, then the primary trend has changed from bullish to bearish. And when it changes back from red to green, then the primary trend has changed back from bearish to bullish. Now you can see this is a weekly chart, but you can see that this took about almost 2 months to really change and really get above the 50. So you could have tried to be aggressive and get in earlier if you want, but if you wanted to be conservative and really make sure that the trend has changed, then wait for that trend change right there. Now look at how close we are right now to the primary trend changing to bearish. So right here is where I would be. I probably would have done it even earlier. And these days I'm watching to see for a close below the 21 is when I start to consider actually moving out. So that would have happened right back here on this bar. And I'll show you that in a minute, a little bit more clear. Same thing on the upside. I probably would have got back in, not here because we're in the red, but probably right where that arrow is. So there's a green arrow above the 21 right there. So I would have got in the same place where that is. But getting out, I probably would have been out right here. Now that primary trend is going to change right there. So everybody can, look at and do what they want, basically what your own trading style is. Now, I had been doing this already. Let me take a sip of water here. I had been doing this already, and I went to the money show. Some of you may have heard this story in the past. I went to the money show, saw a booth there, a company called Turner Capital. And Turner Capital had a chart behind their booth, this chart right here. And of course, understanding charts, I was drawn to it. And they said that they have a proprietary method to get their customers into their clients, to get them into and out of the market on a long-term basis. And when the trend changes, when the primary trend changes, to move them into inverse ETFs so they make money on the downside as well, which I thought was an interesting idea. They are not the only ones that do it. They might say that they're the only ones, but they are not the only ones that have that kind of program. VectorVest has a couple of options of that. I've seen it in a couple of other places as well. I'll kind of explain it a little bit more in a minute. But now that I've shown you the charts that you can use for long-term investing, I'll show you how you can use this particular style as well. Now, Turner just went to the inverse ETF on Friday. So the way that their program is set up, their rules, the rule-based system, one of their rules is they do not move into a position until near the close on Friday afternoon. Because they are using weekly charts, they want the weekly chart to complete at the end of the week before they actually take a position. So they moved in on Friday. Now, let me show you what I do. So I basically saw this and I started asking them questions, and every time I asked them something, they said, "Oh, no, that's proprietary." I said, "Well, this looks like a MACD." And he nodded his head and said, "Yeah, that's what it is." I said, "Well, these look like moving average lines." "Yeah, that's what it is." And in fact, it even shows you what they are right over here. 20-week, these are weeklies. 20-week, 50-week, 86, 200. Those are the weekly charts. And if you go back and look at mine right here, so mine's got a 21, a 50, and a 200. Theirs has a 20, a 50, and a 200, and they put the 86 week for some reason. I don't really understand why they have the 86 in there, because I don't see them really actually using it much, but it's in there anyway. But at any rate, maybe to see when all these things cross and all of them are moving up. But anyway, that I reverse engineered their chart basically, and it essentially came out to very similar to what I had been using already, except not with these same moving average lines. And then I added the cloud in here, and I added a PPO, which is a MACD. So if you'll notice just think of this as a MACD down here. If you notice my green one here and see how similar it is to their green one. on their chart. So this is theirs down below. You can see it's got two red bars just in the last 2 weeks. And it switched over to green back here in about February of 23. And mine looks like this, February of 23. And I've got two green bars right here. So it's essentially the same thing that they have. And then I added a 5 and 13, which actually gives you a little bit of an earlier warning signal. So this actually changed right there, which happens to be the point where I went short back here for the first time. I've gone on my short term, I've gone short twice. I'll show you that in a minute. All right, so that's kind of where I saw something similar to what I had been doing, but added a little more information to it. I thought that was really interesting. By the way, they use this for their clients. They will certainly accept your money if you would like to use them. I've talked to them a lot. I know them pretty well. They're a good company, very reputable. And they basically use the same strategy that I'm going to show you here. I think their minimum requirement is 500,000 to get started with them. I think that's the minimum. They might have lowered it. It's at least 200,000, I think. But at any rate, this is what they do. They will do it for their clients. They move their customers, and they will let you pick the 1x, 2x, or the 3x. So for the leveraged ETFs, for their more aggressive clients, they'll pick the 3x. I'll show you that in a minute as well. But they'd be more than happy to manage your money in the same way. So I created on the website, on the portfolios page, essentially the same idea. And I explain the whole thing right here. It's called the MTS, or the market timing strategy. As I've always said, you cannot pick the top or the bottom, but you can time the market. So it explains here how to do it, what all these things mean. Every day this is updated, just like everything else on the website. That is daily. Today it was updated. You can see right now it is in a short configuration. So that means that it is in the inverse ETF. Now you can't use inverse ETFs in a 401k. So in a 401k, you would either be along the market or you would be in cash, be doing what I explained. You'd be going up or sideways. You would not be going short because your 401k won't allow you to do inverse ETFs like this. Most of them won't anyway. But right now it is short, so it's in the inverse. The inverse right now is at 11%. This is from March 28th. Both of these, the short and the long. So the long, for those that want to use this just for their 401k, all you have to do is follow this. Look at this every day. At the end, after the close, is probably about within 15 or 30 minutes, unless I'm doing something else. It might be later, but usually within 15 or 30 minutes of the close, this will be updated. And just watch when these change. Now, it means you have to look at it every day. Now, I've had some people that send me a note and said, "Oh, I didn't know it changed to short." I said, "Yeah, it's 2 days ago." So you have to look at it every day to see when the signals change. I'll show you what they look like in a minute. All right, so as of 328, it's up 11%. If you had been in the 2X, and I provide all the leveraged ETFs down here, the long and the short. So if you were in the 3X QQQ, 3X NASDAQ, would be this one right here. But the 3X then would have paid 33% since March 28th. So that's about 2 weeks. About 2 weeks now would have made almost 33%. So that's the way it works. And then I put the monthly, weekly, and daily charts up here as well. Now, what I use is the VTI, the Total Market Index. And this is something that I got from Turner. Turner says that they have an index that they say is proprietary, but it encapsulates all of the other indexes. And guess what? That's what the VTI does. Vanguard Total Index is made up of the Dow 30, NASDAQ 100, the S&P 500, the Russell 2000, and 3,800 other stocks. So it literally is the total market. All right, so that's pretty much, they say there's a proprietary, and I do think that they make some changes based on what they're adding to it, but essentially it's the same thing. All right, now let's look at I'm going to look at the monthly first, but the weekly is what this top line uses, and the daily is what the second line uses. Now, the advantage of the weekly, of course, if you're in a 401k, it's tax deferred anyway. But if you wanted to do this in a regular account, the advantage of the weekly is that normally, it will run for over a year. So you get the advantage of long-term capital gains. Whereas the daily will switch in and out much more quickly. So you'll be paying short-term capital gains. But you can see over time, this is all based that the calculation is from November 3rd of 23, which was the bottom of the bull market where it first started. And you can see the difference right there between those two. So if we look at the monthly, we'll look at that first. The monthly is very interesting because it actually shows you when the MACD crosses the zero line right here on the monthly chart. So to the downside right there, just follow those arrows down right here and right here. And what you'll notice, and also, actually, this is the bullish one. So on the red ones, the red arrows, what you'll notice is that's close to the top of the market. Now, again, you can never pick the exact top or the exact bottom, but you can see that they are very close to the top of the market where the PPO crosses. So that's the thing to watch for on the monthly chart. If we look at the date on this, now this is a month, so this one is March. So this crossed in March. You can see by the end, it was sitting right on the 21 in March. So sometime during the month of March, this all crossed over. All right, so that's the monthly. The weekly is the one to use for long-term investing or using it in your 401k. And in this case, you can see the blue line is the go to cash. So this will say either long, cash, or short. So it'll stay long for quite a long time. It stayed long from November 3rd up until, actually, well, I can look at it, up until right here, right, beginning of March, same as the monthly. So that was the go to cash signal. And then the short signal was over here, just to confirm, to make sure that it really was going down, because it could go below, during 1 week. You've noticed back here it went below the 21, but it came back by the end of the week. That's a reason to wait until the end of the week, just like Turner Capital does. This is a great example of why to do that, because anytime during this week, it could have been below the 21. You might have gotten out, but by the end of the week, it was above. So kept you in all the way up here. So this was the first week right here where it went below. So that was the week of March 3rd. That's a Monday. So sometime during that week is when the move to cash. So this is the long signal back here when it closed above the 21. That's on, it was actually on November the 3rd. It's the week of October 30th. October 30th is a Monday. So November 3rd is when the signal happened. And it stayed long until this cash signal right here. So all of these signals are right here on the chart. You'll see it on the matrix that I showed you, but I also will put them right here on the chart as well. And then the go short. So this would be the time to get out if you're in a 401k. You get in right here. In this case, there was a bullish signal back here, go to cash right there. And you would be in cash for 1, 2, 3, 4, 5, 6 weeks. And then you'd be back long again. You'd ride it all the way up. And then you'd be back to cash here, and you would still be in cash right now. So you would have missed all of this downside right here in your 401k. Now, if you are still in your 401k right now, of course, it might be too late to get out, especially since we typically will have rallies somewhere in here. And I thought we might have a longer rally, but we'll see what happens tomorrow. All right, so that's the weekly. And then finally, the daily chart down here, this is the second line. That's for those that don't want to ride those intermediate downtrends. The daily chart will have more trades. So this actually was also from November 3rd. Wrote it all the way up here. So that was the go to cash signal, and this is the short signal. So it was short down to here, and this is go back to cash. So this was a short all the way but down here, go back to cash and then short again right here. And you can see the date right there is March 28th for that short. And it is still short even now. So that has not changed. So that's pretty much how this works. If you are a subscriber, you will see, everything in here on the MTS. It explains how it works. I update this every day. You'll see the signals change. You'll see the information right on the charts. One other thing I need to mention is that the VTI is not necessarily what to trade. This is not the trading vehicle. This is just the signal vehicle. So that doesn't mean you get into the VTI. You make a decision of what to get into. You decide whether you want to do a 1x, 2x, or a 3x ETF, or you can go directly with the S&P, NASDAQ, or Russell 2000 if you want to. Or if it switches to long, then you make the decision of whether you want to get 1x, 2x, or 3x, and whether you want to get into the S&P, NASDAQ 100, or the Russell 2000. So let's say in this case, we're short and we wanted to do triple the Russell 2000. That would be this one right here. So you can see on March 28th right here. So that was the signal on the VTI. Remember, the VTI is just for the signal. That's not for the trading. So this is where you would have got in right here. Basically, it closed at 1679. And today it was closed at 24.41. So that's about $7 or what, 50%? It's almost 50% gain in 1, 2, 3, 4, 5, 6, 7 days. This is a daily chart. So that's the way to use it. You have to trust the signals, and they do not always work. Nothing works 100% of the time. But this system has actually worked pretty well. Works most of the time, but I will not guarantee it. Nothing works 100% of the time. So you have to use your own judgment, decide which ones you're comfortable getting in, 3x, 2x, etc. Over here, I do a relative so you can see the relation between the long and the short. So if we look at the same Russell 2000, this is the long version, TNA. You can see over here is a 3x, or TZA, it's a 3x inverse. It shows you the relationship between the two. So it's got the long and the short down here. You can see they are mirror images of each other. So the time to get out, I think, was back here, probably somewhere in this area. And then time to get back in was on the 28th. All right, and then the relative chart shows you, which one is outperforming the other. All right, so that's how to do it. Let me know if you have any questions on that. I hope that makes sense. You can read through the rules right here. You are welcome to go to Turner Capital. I don't mind giving them an endorsement. Turner Capital right here, they put out a newsletter every week. By the way, let's show you one thing. Let's go back to the weekly. And remember, I said Turner went short right here last Friday. So they went to their short ETF right basically at the bottom of last week's, because they wait till right at the end of the day on Friday. So that's when they went short. And you see on mine, I went short the week before. So mine actually took advantage of this whole downtrend right here. And then they are still short right now. Now this is about to give a primary trend change here very soon. This is a weekly chart, so probably I would say in the could be as early as next week. Depends on if we get a rally or not, but probably within 2 weeks, we're probably going to get a primary trend change here pretty soon. All right, that's how to use it. I've actually had some people tell me that they've had success with it. Let me see if I can find that one. I should have had it up and ready, but so for yesterday's YouTube video, I think it was near the top. Yeah, here you go. So don't know this person. This is just an unsolicited comment. Use the market timing strategy to move to cash bonds in my 401k and has saved me nearly 25%. And then he sold this. I don't know what this is. I haven't looked at it. Thanks for the education. So this person, and there's a number of others that are using the MTS, the market timing strategy, to do exactly this in their 401k to allow them to move into cash to avoid all of that downtrend. All right, so it's a very effective tool. It's not unique to Turner or to me or to anyone else. VectorVest has a couple of versions of it. There are lots of other companies out there that have versions of this. Just watching the long-term weekly chart, moving out to cash. So I just put it here with all the rules just to make it easy for everyone. And down here, there's some additional charts. So you can see here on this weekly one here, which is basically the one I started with. So that has the shading for the colors and everything. So it actually shows you what it looks like. All right, so that's it. Thanks for watching. Be safe out there. We'll see what happens tomorrow with CPI. First thing in the morning, 8:30 might make a difference. Maybe a big volatile day on the other side. We shall see. And stay safe. I'll talk to you soon. Take care.